Hey guys, good morning and welcome to the Camp Financial stock market update for, well, it would have been yesterday, which was June 27th. And I just want to start with the indexes, I guess, with the Brexit deal obviously still continuing to cause a little havoc in the market out there. You know, what's safe? Well, right now there's not much that is safe. I mean, there's aspects of all three indices are seeing a lot of pain. So I don't think there really is a safe trade this time. I mean, you can't really trade into bonds because bonds are paying almost no dividend. So like I said, it's very interesting position that the market finds itself in right now. So anyway, so the Dow yesterday ended up down another 260 points, or 1.5%. The Nasdaq was down 2.4%, and the S&P 500 down 1.81%. So yesterday, I am taking a little look at the heat map here just to get an idea. So yesterday, looks like AT&T and Verizon fared pretty well. The real estate investment trusts performed pretty well. And let's see, of the tech and finances are the ones that perform well. Consumer goods, cigarettes performed well again. I find very interesting, but people, once they start smoking, it's hard for them to stop. So I mean, I guess it kind of makes sense to a point. Grocery stores performed pretty well yesterday. Kroger had a pretty good day, up 4.2%. And then the other sector that did quite well, obviously basic materials did decent again with gold. Gold stocks performed well. And then the one sector that had very few stocks down on the day yesterday is the utility sector. So electric utilities, there's a couple of them that were down. AES was down 4%, PPL down 1.64%, but the majority of the others were up anywhere from 1 to 2 points, with NextEra Energy, which I am unfamiliar with, NEE, actually up 3.3%. So that's one I'm going to probably have to take a look at. And then in the diversified utilities, actually, so NRG, stock symbol NRG, was down 4.79%. ES performed the best of those, up 2.39%. And one of the stocks that I recently purchased, it is in that portfolio of undervalued stocks, these stocks that I felt were undervalued. So I took a look and I bought into EXC. That would have been toward the end of April, and EXC was up about 0.6% yesterday. So again, we're going to continue to see pain from Brexit. Give me just a second, I'm going to grab something. Okay, sorry for that. I think we're going to continue to see pain from Brexit, and I also think that Brexit is going to cause additional EU pain as other countries within the EU start to think that maybe it'll be in their best interest to leave as well. All of that's going to obviously play out over time, but it's just my thought on what could happen. So now I'm going to take a look at my portfolios from yesterday. The technical trading system had two stocks that were up. That was Blue Cap Reinsurance Holdings and Agnico Eagle Mines. Obviously a gold company and a reinsurer. The reinsurer is very stable. It's consistently, just pretty much hung right there in the mid $17 to $18 range and just throwing off the dividends. Let's see. I'll take a look at the undervalued, what I was buying, undervalued companies. Obviously Unum Healthcare was crushed again yesterday, down another 6.46%. So in a matter of 2 days between Friday and Monday, it has went from a close on Thursday at $35.52 to a close today at $29.99. So it's lost almost $6. It's down about 15% in 2 days. So I mean, obviously that stinks. I feel the pain in it for sure. But I still feel like I've got a good company at a good price, and that the once the dividend gets in there, it gets reinvested. Over the long term, this is a good compounding opportunity. So now we'll take a look at my last portfolio here. Like I said, that's the one that's been around the longest. I've been trading it for a little over 5 years. Actually, it might be 6 years now. And for the most part, obviously, it's primarily red as well. Did have a pretty good day in stock symbol ARKR. That's Arkansas Restaurants, I believe is the actual name of it. ARC Restaurant Corp. Sorry. It was up 6.1%, $21.40. $1.23 on the day. And then the other big one that was up yesterday was BGS, which is a packaged food company. And again, that makes sense when the markets are tough. People are looking for safety, security, so they're looking to buy into the consumer staples. So, like I said, rough day yesterday in the market. Continue to expect more difficulty coming forward. At least I do. I don't think that this is going to be, just an automatic, oh, okay, well, we went through 2 days of pain and that's it. I think that we still got more pain coming. It's just a matter of understanding, how to ensure your portfolio, by buying some companies that are going to go up when the rest are going down, and knowing what price you're willing to pay and at what price you're going to get out, because you're not going to deal with any more pain, on the downside. So. Now I want to take a look at. So yesterday I did a little piece on personal finance, and I was presented a question from someone, and so it says, so we're looking at a recent college graduate and their plan, for life, I guess, going forward, for their money going forward. So they make $45,000 a year and they owe $15,000 in student loans. And So one of the things that they ask is, how do you feel, what would you recommend to this person in regards to participating in her employer's 401k? Well, they're a recent college grad, so that tells me you've got 40 some years to compound. So I'm definitely going to explain to them the benefits of compound interest. Being able to find a company that pays a dividend, or even if it doesn't pay a dividend, find a good growth company, something. But explain to her, your compound growth over time is what is going to make you wealthy. So you need to invest in your 401k, absolutely. Plus, the other thing to remember is, for the most part, once you consider your state tax, your federal tax, healthcare, etc., you're looking at 30 to 35, maybe even 40%. Especially somebody that's making $45,000 a year. That's what you're going to bring home. You're going to lose 30 to 40% in taxes, healthcare, etc. So, okay, so if you invest enough to meet whatever your employer max is, so say for example your max is 6%, or they'll match you 1/2 on each point up to 6 points. So essentially what that's saying is if for every percent that you save, the company will put 0.5% in. So if you go up to 6%, they'll match 3. They get you 9% total going into your retirement account. But on the other side of that is you're only going to miss 65% of that out of your take-home pay. So, to make numbers easy, we're not going to use the $45,000 number. Let's say your take-home is $3,000 a month, and you're going to invest in your 401k. Well, then essentially, if you put 6% in, you're only going to lose 60% on that 3,000. So your take-home pay is not going to come down the full. Boy, I didn't use numbers very well at all on this, but it's not going to come down the full 6%. Your take-home isn't. You're only going to miss out on 60% of that 6%. So as far as your take-home pay. And then the other thing that I would tell her, obviously, is with $15,000 in student loans, that if you can get an apartment, start funneling the money into that, get that $15,000 in student loan paid off, then you have the ability to start saving money for your, outside of retirement as well, where you can take that money, either invest or purchase a home, whatever it might be that person's interested in doing, and be able to build a nice nest egg investment portfolio outside of your retirement account, and that's just going to help you in the long run. So one last thing, I am starting to take a look at a stock ticker, and it is AINV. That's Apollo Investment Company. It's going to take a little bit of time to definitely dig into the whole thing. I've seen some recommendations on it because it pays a huge dividend, and I did take a real quick glance at it yesterday, and I think that the dividend is safe. This is a $5.25 company that pays an 80-cent dividend, or almost 15%, 14.7% dividend yield. But looking at the net cash flows, it looks pretty safe as far as the cash flows go. So what I need to look at now, and what I want to do a little deeper dive into, is look at what they own within their portfolio. You know, I did take a quick glance at it yesterday. I seen they got a lot of 8, 9, 11% paying bonds. You know, how stable are those bonds? Are they going to be able to continue? You know, what all is going on there? So just because it pays a 14% dividend doesn't mean that it's something you want to buy. Because if you get a 14% dividend, but the stock trades from $5.25 down to $4, well, now you've lost almost 25% for a 14% dividend. So you're still net negative 11%. So buying into these aren't always a great idea. You got to do a lot more research than just saying, oh look, it pays a great dividend, so maybe I should take it. So alright guys, that's it. Thanks for listening. Again, if you have any comments, questions, leave them here on the YouTube channel. Find me on Twitter, or send me an email, chrism@campfinancial.net. And also, if you're interested in having me, sit with you, do questions, I mean, we can do it on Skype even, to help you come up with a financial plan that works for you. And that doesn't necessarily have to be investment planning. It can be, what do we need to do with your finances to help improve your current cash flow, so that in the long run you can start saving money and using that to build wealth. So alright, that's it guys. Thanks, and we'll see you tomorrow.